Awesome. Hi everyone, and thank you so much for being here with us today. So, Today you are attending our third and final cash flow training webinar with our amazing finance team. This webinar is presented by Amity Foundation, acting as the third-party administrator for LA County's Justice Care and Opportunities Department and the CFCI Care Grants. The CFCI, or Care First Community Investment, grants are the result of ballot measure J, voted in by LA County residents in 2020. Care First Community Investment Funds are intended to be invested directly into communities and alternatives to incarceration that address negative outcomes caused by racially driven criminal legal system inequalities and long-term economic disinvestment. Today's webinar is being recorded. You do not have to be on camera as we are in a webinar and you'll only be able to see the panelists and what is being shared on the screen. Staying on the webinar though, does mean that any questions or if you unmute yourself, it may show up on the recording. So I will hand it off now to David and the finance team.
Thank you, Mina. Hi, everyone. Welcome back for those of you who've attended previous seminars or series. If you haven't, this is your first one, I still think it will be useful, but encourage you to go to our website, as Mina has laid out, to look at the previous recordings and series. And so I'm going to start off by an introduction. I'd like my team to introduce themselves. Again, David Crawford, I'm the Chief Financial Officer of Amity Foundation. I've worked with Amity for 7 years now. I've been a CFO for way too long, 20 plus years. And I'm happy to kind of share sort of best practices with you all. So with that, I'm seeing you, Lorenzo. Do you mind introducing yourself and then popcorning around?
Yes, sir. Thank you. Hello, everyone. My name is Lorenzo Gonzalez. I'm an accountant here with Amity since March. It's good to see everybody here. Don't get discouraged. Practice and use this, and you're going to find that it's going to help you. So I'm excited for you. Don.
Thanks, Lorenzo. Hi, everyone. My name is Don Dell, also with our TPA finance team, one of our senior accountants, and just hope that you get the most you can out of this. And remember, this is something that you consume over time, not eating in one bite. So to Lorenzo's point about not getting discouraged, keep after it, review it. And again, we're always here to support you if you have questions down the road. Sam, if you would go next, please.
Hi, everyone. My name is Samuel. I'm also on the TPA finance team. I've been with Amity now for 3 months, and I will send it over to Sandy.
Hi, everyone. Sandy Kleinschmidt. I'm the Senior Vice President of Finance at Amity. I've been with Amity for almost 8 years now, working with the TPA grant ever since the very beginning. So it's been about 1.5 years. And welcome, everyone.
Thank you, team. They have done an amazing job of helping put together these materials. What I heard from Don and Lorenzo is that, is to hang in there. We understand this is complex. We're finance people. We live and breathe this every day, but understand that may not be true for you. So just want to acknowledge, it is complex. We're hoping that for those of you that are following, that the tool that we will send out, and we will send out the Excel tool I'm about to go over today, and for you to use. For those of you who still aren't feeling comfortable, I would encourage you to think about finding resources. I might be able to connect you with some resources, so you could always reach out to me if you feel like you need help using the tool and doing the work that we strongly encourage you to do to understand your cash flow. So with that, I am going to share my screen and go through some PowerPoint slides first, but then we're going to dive right back into the model. I think before I get going, sort of one last thought. I'm hoping today that the groundwork we laid in the first two series are really going to pay off today, where we actually use the model and you can see it, the usefulness of it. I think I would acknowledge the last session was maybe a bit of a slog as I introduced the model to you, and there were numbers everywhere, and there were tabs and whatnot, and so we're going to use it, and I'm hopeful that it'll all start to come together, for you. And so at the start, this is the disclaimer I've been presenting. Our lawyers like us to present this, and it essentially says that what I'm about to present to you and discuss is not legal advice, intended to provide you information and best practices as I've described. Please, independently verify any information presented when appropriate. Make sure it's applicable to your business before acting on this information presented. And having said that, as Don said, the team, Don, Lorenzo, and Sam are here to help you. They're not responsible for building and using the tool, but they'll certainly help you review it and give feedback on it. But just want to set that expectation clearly. To the extent you're not feeling comfortable, you need a resource, we can work to help you find a resource that that you can use and get paid for within your budget, to the extent you have your contract budget, to the extent you have unspent funds in your contract, which most of you or all of you should have. So this is the third series, as we've talked about. I'm going to stop at an hour and a half. We've scheduled two. It's just, it's a lot of numbers and spreadsheets, and so we'll go as far as we can in an hour and a half. If I feel like we haven't gone far enough, we'll schedule another training. We've identified other areas of training around tax filing requirements and labor laws, and so I can certainly wrap in, the finishing elements of this into go forward training. So we will stop at after an hour and a half here at 3:30 Pacific time. And so what I'll do today is review very quickly what we talked about in series 1 and 2, and then we're going to go right. I'm going to review the calendar again. We built one for cohort 3 and PA8 that I want to show, or Lorenzo did, not me, and so that we can talk about dates a little bit and some of the feedback we got around some of the dates falling on weekends or holidays, and so I want to talk through that a little bit, and then we're going to build something together, a fictitious, business, and show you how cash, flows based on, the information, we input into the Excel model, and then I'll wrap it up, and certainly ask questions at any time, as Mina pointed out. Use Zoom Q&A. My team will answer questions as they're being asked. Mina will find pauses in my presentation to ask me questions that maybe haven't been answered in the Q&A, but my team will try to knock those out real time. So in the first series, 2 weeks ago now, we attempted to lay sort of the foundation, and you think about a house, and if you remember the slide, I actually had a house with showing cash dollars going in the house and cash going out of the house. And that's fundamentally what we're talking about. We're talking about the change in your bank statement or your bank balance over a period of time. And that period of time can be a day, it can be a week, and it can be a month. But that's cash flow when we use that terminology. And so you need an accounting system. You need to build your chart of accounts. We talked about how to build it, thinking about your external reporting requirements, tax reporting requirements, our requirements of you, your budget to actual quarterly spend, what categories do we ask you to submit to us. If you structure your accounting system to match that, your reporting becomes much easier. We talked about the need for a software system. I'm a big fan of QuickBooks and QuickBooks Online. So to the extent you're looking for one, I provided a link to QuickBooks. It's easy to search it up on the internet, but we can certainly help you with that if you need a link to QuickBooks. And so then once you have the foundation of the house or your accounting system, you then enter data. You enter your transactional data and your spend, the money that comes in as we pay you, the money that goes out as you pay your staff and as you pay your vendors, your rent and so forth. And you get all that information in through your bank statement, and you look at all of the money coming in and going out, and you enter that into your chart of accounts, into your accounting system. And by doing that, going through what's called a bank reconciliation, you know that all the information is in and it's accurate, and you can then rely on it. And so with that data in, it can inform you to better forecast your future spend. And I used an example of utilities or a phone bill. When you first have a utility or phone bill, you're not exactly sure how much it's going to be, but as you're paying it, it generally starts to be about the same every month. And so you can then forecast more accurately what that spend will be. And so that's just one example of how you can use the data to help you forecast your future spend. And then we've been really hammering home, the sooner we can get information from you every quarter, the sooner we can pay you. And we showed a calendar, representing that. And that's your number one way to reduce cash flow risk. And cash flow risk fundamentally is a concern or an inability to make a payroll. Which is absolutely a no-no. There's California law around having to pay your employees at least twice a month and having to pay them in a timely manner. And Mina gave a link in a chat, and I included it in the slide materials in series 2. And so we really need to make sure we're making payroll. And the biggest thing under your control is allowing us to invoice the county, JCOD and LA County, receive those monies and turn around and pay you. So we'll be talking about that more today. And then series 2 is when I introduced you to the tool we're going to go into, and focusing on certain tabs. If you remember the green tabs, we'll see them in a moment, they're really about your bank balance and what that is projected to be daily in the short term, and most importantly, what is it projected to be as you're leading up to a payroll. And so this is the calendar I showed in series 1 and series 2. It is the appropriate calendar for cohorts 1 and 2, which are years 1 and 2 awardees. Their quarter end ended November 30th. And so they then were required to submit their milestones and their budget to actual by the 5th calendar day. So it's not a business day. It includes Sundays and Saturdays. And for those who submit accurate information that's reviewed and verified by Sam, Lorenzo, and Dawn, if the data you've submitted comes in and it's accurate by the 13th, then, which is past, we will include you and your invoice in an invoice we then send out to JCOD and LA County on a Wednesday, on the following Wednesday. And so this is the cadence we've worked out with JCOD / LA County to invoice them on your behalf, which then starts their approval process, and I'll show that to you in a moment here. If you miss the 13th date for submitting accurate information, so it's not just submitting information, it has to be correct, then your next opportunity is the following Friday, December 20th, which is, coming up this week. And if it's accurate at that point in time, we'll include you in the December 25th invoice, which may go out the 26th. I don't expect my team to work on the 25th, but you get the idea. We just want to show you, what the normal quarter looks like, ignoring for a moment holidays. And then the third opportunity to get included in invoice to JCOD, if you miss the 13th and you miss the 20th, those Fridays is the following Friday, the 27th, and we will then include you on an invoice on January 1st to JCOD. And then the fourth one you see here. And what that means is the first invoices we submit get turned around to us first, which makes sense. And so this is about how long it has taken for JCOD to in LA County to turn around an invoice. The contract that we have with you says that we have 45 days to pay you once your information is final and correct. And so we've been paying you, and our intention is to continue to pay you more quickly than that. We really are doing this as fast as we can. You're working hard with you to get the information in, and working hard with LA County, to prove the invoices and to pay us. And so you can see then the blue comes in a little bit later, the second invoice, and the third invoice even later, and the fourth invoice, even later than that. And then, super important to point out for cohorts 1 and 2, if you miss January 3rd, you miss this whole cycle. You get kicked into the next quarter, and we just can't have that happen. That so we definitely need you to make us aware if you're running, late here in the quarter and you haven't submitted everything. And the advocates on our side should be working with you and aware to make sure you're getting this information, because that is something that that should never happen. And so, thank you, Lorenzo, for putting together. We got some questions around the second group of awardees or grantees, and these would be cohort 3 or year 3. And one of the, I think it's year 1, has a separate calendar cycle that aligns with cohort 3, year 3. It's called PA8. And so as that comes up in January 2025, due date is still the 5th calendar day after year end. Yes, it's a Sunday, but as I mentioned, you really have until the Friday, January. Now, we get a little nervous showing you this because we really want to make sure you work hard to get it in as quickly as possible. We understand those are the holidays, but you do have a little bit more time, which is why we didn't worry about business days versus calendar days as it relates to the 5th, and then so on and so forth. The logic works the same, and you'll get these slides. Mina will send them out, and so you can see the dates here for cohort 3 and PA8. Okay, with that, Mina, are there any questions before I dive into Excel?
No, you can dive in. We're answering things on the side. Thank you.
Thank you. You guys are amazing. I appreciate it. Okay, so this is a very similar Excel model that I went over laboriously last time. And so, want to remind everyone how it's structured. This initial tab, I call it the user guide and information. Not going to go through it with you, but it describes what's in this model, the different tabs here, the green colors, and it then describes how to use it. Down below, I have how to build it. I'm not going to read it out or go through this with you, because we're going to do it. I'm going to show it to you in a minute after I'm done just reminding you of how this thing is structured. And so you will all receive this model and you'll receive the one that's relevant to you. So, there's, as I mentioned, there's different cycles for cohort 1 and 2, and then cohort 3 and PA8. And so and I show that here. So for, I don't know what's going on. So for cohorts 1 and 2, you will receive a model that has this tab, but does not have this tab here, and vice versa for cohort 3 and PA8. The green tabs are the critical ones. This is where we need to be understanding the business, and the cash flow is looking right at these tabs. But the information that gets populated in these tabs comes elsewhere in this model. And if you remember my yellow is sort of my favorite color for when I input an assumption. And we'll look at that in a minute if that's not clear to everybody. The purple ones here, I'm going to call this purple, are really accounting the 3 statements that I've mentioned last time. So as you talk about an audit or any kind of even a public company, one that has a stock ticker, they will issue 3 statements, and these are the 3 statements. One's a cash flow balance sheet, and the other's the income statement. They're not the thing we're going to focus on here, but for somebody who's comfortable with this model, or as an accountant or a finance, they're going to want to see this, and understand it, and all the numbers, flow. And so know that the purple ones are important, but are not going to be the focus area as you're using this tool to manage your cash flow. And so the yellow here are the ones where we are inputting information about the contracts we have. And I've expanded this to allow you to have up to 5. It's not too difficult for somebody who's comfortable with Excel to add more if you happen to have more than 5 different contracts or programs, and they're the same. I'm using them, the language interchangeably, whether it's a contract or a program, because you do want a separate tab, if you will, for every contract, and track the costs associated with every contract. And so I've added this, in the event that you've got, more than just JCOD, and before I had only program 2. And so I'm hoping that then is useful for you. Right now, there's no information. If you remember, last week there was lots of numbers. It was probably, an overwhelming, I can appreciate it, slide to look at, but right now we have nothing in any of these. I'm gonna even delete these here. And this is what we're going to do with the remainder of our time, is we're going to start filling in this this information. So the first area to start is this payroll tab, and this is your headcount. This is your staff, and this is where you want to start when you're building your budgets. And I have budget up here very explicitly. And best practices are, most nonprofits have a fiscal year that starts July 1 and ends June 30. Not all, but most have that cycle, which is why I've chosen those dates here for July. But you can change these dates. It's very easy to do. You can use this model to change this to 2025. So for next year, it's again, something that is a tool that you can configure over time. And so the first thing you want to do is set your budget for the year at the beginning of the year. This is typically done in May, June 2024. You're starting to think about it and work on it. You haven't ended your current year budget. That ends June 30, 2024. And so that's when you start it. Best practice is to bring it to your board for approval. But as you're building it, so if we're in May and June, and I'm building this, I'll start to enter information. And so in the example I'm going to use here, I'm going to come up with, these are random numbers on how much I'm paying my program manager, 60,000. And then I'm going to pay my case managers, let's just say 45. And so this will be whatever is true, obviously, for your contract. I did something wrong. So let me redo that. There we go. And in my example here, I'm going to assume that maybe this is cohort 3, and this is a new program that we've started. This is the JCOD program, and so this is my head count for JCOD. And I'm going to assume we had 2 people ready to hire, and we hired them July 1, and then it took us a little bit more time, to hire positions number 3 and 4, and then maybe a little bit more time even to hire positions 5 and 6. Okay, so 1 represents 1 full FTE. If somebody's working for you half-time or a fraction of a time, you can put that in here. You would put 0.5 for half-time. But in my example, these are all going to be full-time. And so I expect them to be working for me the whole year. So I'm going to reflect that here. And I'm going to then assume, so that's my head count. This is my budget for JCOD as it relates to just the head count. And then I'm going to assume I have a second program here that starts Jan 1, let's say. And same thing where it takes me a while to hire everybody. So I'm going to reflect it that way. And so then this is my budget, and that's all I'm going to do for this exercise. You can fill out, the other programs if they make sense for you. It works if you're not just starting July 1, 2024 as a nonprofit. You can, make these all filled positions at the beginning of July, and it'll work. There's many different ways you can do this as it sort of is relevant to your business. And so by entering this information here on the payroll tab, what now has happened is it's populated my costs here for that staff based on the salary and based on when they started. And so that's why you see the costs lower at the beginning in July, because I only had 2 employees, then I had 4 employees, then I had my full 6. And then program 2 didn't work. Let me do it. Let me do it real time, brother. Oh, I see.
That's the life of Excel.
No, I'm not thinking. I didn't pay them anything. So that's not right. And so let me pay them. And I'm just gonna, embarrassing. Let me pay them the similar salaries, right? And so now let's go back here, and there you go. And so what then should happen is you're done with your payroll now. Then we want to look at these 2 programs, right? And we'll start with program 2. And the way I model this, and I encourage you to do it this way, is on a percentage basis. And my experience is health benefits are about 20% of the salary. And so that's the math here. It just takes the salary for the 2 people times 20%. That's my health insurance cost. And then I've done this so long, I know that workers' comp is about 5%. And I also know employer taxes. This is Social Security, the employer's responsibility for Social Security, and other SDI is also in there as well. It's about 8.4%. And so it then computes what those costs are for those benefits. And so that takes care of headcount for this one program, which is program 2. Then we need to fill in what's, the other kinds of costs. Let me do one thing here. It just makes it easier to review. And so our what I call non-headcount costs, rent should be applicable to most of you. I'm just going to assume it's $1,000 a month. And so this is a per month number, as you can see. And then utilities, let's just say 200. I'm going to say my phone bill, that's going to be more than 200, 500. And this is 200. A little bit of office supplies. And maybe I'll just do insurance here, about 500, let's say. And so you can fill all these out. You can also add rows here, right? To the extent you have a different chart of accounts, you can add them here and customize it. you know, again, whatever's relevant to your business. And then down here we have, you know, there's been this um, a concept of indirect costs, and the language is, I forget what we call it in the, Don, help me out. What do we call it again in the budget budget
Project
template support?
management.
Project management. So they're the one and the same. These are costs that are shared. And so if we have two programs and you have somebody like me, a finance person, a bean counter, um, uh, the way to reflect and to categorize my cost is in this line, indirect, because in this example, a proportion of my cost should go to program 2 and a different proportion should go to program 1. And I wrote a note over here to give some examples of what our costs that should be in here. And I'm just going to assume these are, you know, 1,000, let's say. Okay, and the way I've set up this model is you see here this net income line. It is revenue minus expense, and the assumption in this program too is that it's cost reimbursed, which means the revenue equals the cost. You incur your costs, you invoice the contract, and they pay you the revenue and the cash that offsets the cost. So you don't make a profit or a loss. And so you may need to change this if the contract is different than this. A lot of contracts are cost reimbursed. Ours are that way as well. They're a little bit unique, as I'll show you in a minute. The way we pay you up front and we pay you the full quarter. And as I showed you in this example, in almost all cases, there probably was a ramp to your hiring. You wouldn't have hired before you knew you had, you'd won the award for your JCOD services, and that's reasonable, right? You don't hire people before you have the means to compensate them. And so, as I'll show shortly, most of you should have a surplus, sort of an extra cash, because you didn't have to spend, even though we pay you assuming, because that's what you submitted, and we knew this very consciously, so there's nothing wrong. In the budget you assumed for your award amount, it assumed everybody was working at the very beginning over the entire period of the contract, which is again not true for many of you for reasonable reasons. And so that's an important thing to understand, is that you've gotten that money up front. We paid you that first one as quickly as we could when we executed the contract, knowing that you needed to make payroll, and knowing that you'd have some surplus because of this delayed hiring ramp, to just help you manage cash flow, and not necessarily just manage your JCOD cash flow. We understand that you may or may not have other contracts, and that's normal, and to have more than one, and funders pay us differently, and so it's not reasonable to expect that you only use the cash you have from one contract to pay the people in that one contract. It's important that you understand over time and over the life of the contract that you're going to receive as much money to pay the services for each contract separately, but the timing of that cash flow varies. It's one of the most frustrating things for me about the work that we do. Right, we were so focused on the mission and the services, and yet many funders don't pay you up front, and that'll, I think, get highlighted as we go through this scenario. And so it becomes very difficult and in fact impossible as a business, for you, especially being smaller. Like, we go to the bank, we are able to get lines of credits, we get credit cards, and it's just because of our size we're able to do that. That's not necessarily true for you, which is again why we consciously paid you up front the full amount, and we're trying to pay you as quickly as possible so that you again never run into a cash flow shortage. And so we're done with program 2. I'm going to finish up program 1, which is JCOD, and I'm just going to put a little bit different percentages in here because they will be different. They're not necessarily going to be the same, these same benefit percentages. The employer tax will be the same, but the workers' comp may be different. The rates vary depending on the staff and the work that you do, and whatnot. So just want to acknowledge that these may not be the same. And then let's just put some numbers in here on rent and utilities. It's a smaller program, so I'm going to put smaller dollars here. And let's just, what did I do? I did insurance here as well. I'm doing the things that I think are applicable to every one of you. The others, maybe not so much. So if you're curious why I'm picking certain ones and not others. And so the last thing I'll do is here put down my costs and IT costs, and I've put more costs here because this is a bigger contract, and so it should pay for more of my costs and the administrative costs, such as IT and HR, which is why over here I had 1,000, and in the JCOD I have more. Okay, and one thing I want to highlight for you here, and I talked about this in the past, and it may make a little bit more sense given what I just talked about with the payroll. You will have, from an accounting perspective, you will have a profit as you first start your program. And it has to do exactly with what I said. You don't incur all of the costs because of the delayed hiring, even though you get a full quarterly payment. And the quarter payment is the same the first quarter of your contract as it is the second quarter, and so on and so forth. And this is where essentially you'll have a surplus. And what I've communicated to all of you is that it should be your expectation that at the end of the 3 years, if you haven't spent this elsewhere, because you can spend this in a future year in 2026, you could spend this. And if you don't, though, we're gonna reach out to you to ask for that money back at the end of the contract. That should be your expectation. But it can help you during your contract period, right? As you're managing your payroll and your vendors and your rent and all of those things. It can certainly help you through the 3 years of your contract. Okay, so we've entered all of this information in. It now adds the two together into this tab. So this is the sum of the two contracts, program 1, program 2. And if you put program 3, 4, and 5 in, it'll add it up here as well. There's no yellow, so we don't input anything here, right? Remember, the yellow is where you input information. I'm not going to review the balance sheet. It's for maybe advanced cash flow training or maybe financial statement training in the future. It only has one assumption. I'll just point that out. Yellow. I put an assumption that we purchased a car in January of 2025, or we budgeted to purchase a car. It actually got us into a trouble. I'll show you. It was what you see here in red. But there's only one yellow here. There's only one assumption, and the rest of it is formulaic. It pulls from other information in the yellow tab. So we're not going to focus on this. It then calculates the cash flow statement. And if you recall, there's two different ways to do it, and one's a cash flow statement. And so this is your change in cash by month. And I should have done my freeze frame here. Bear with me, please. So this shows that I had us starting with $1,000, right? This is a new nonprofit, and we start with $1,000, and we receive the JCOD payment is essentially what's going on here, and so we ended with 87,000, and that was our beginning cash balance for the next month, and then we spent money and so our cash goes down. And so you see the detail up here as to, and this is a very accounting way to look at cash flow. So we don't want to focus on this. It's a useful statement again for somebody who is a professional accountant. The one that's more useful is this one for us, which is called the direct method, which you see very clearly and logically, like when did the cash come in? And so in my example, it's JCOD, and this was a new contract for cohort 3, and we paid you up front. And so this is why at the end of the month of July, you have 87,000. It's because 104 came in, your first quarterly payment. Then we paid our payroll, we paid our insurance, our health insurance, and these were our disbursements, so cash out. And so the change, difference between cash in and cash out, was 86,000. We add that to the cash that we had at the beginning of the month, which was 1,000, and we're in a good position. And this is where we hoped, in fact, all of you were, whether you're cohort 1, 2, or 3, or PA8, because of that first payment, you should have had a nice, big, bank balance the first month of your contract. What then happens is you don't get that payment for another, it's actually 4 months, because now we have that calendar process where you submit the quarterly information and we get it approved by JCOD. And so the second invoice you got came a little bit later. And so you see your cash balance going down, 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 then up, and then down, down, down. And so, and the reason it went down is I had us buying a car here, which was a bad idea because the way it's assumed in here is we didn't receive any money to buy the car. We just thought we could buy it because we had 38,000 at the end of December. And so I'm going to now realize that was a bad idea. And so we're not buying the car. And now it's still red, so we're not quite there. And as you know, our balances can't go negative. And the example I gave last training was we can't go to the ATM and draw more cash than we have, in our bank account. And so this is a way to flag that there's a potential problem as you're putting your budget together. And so we'll not dive into that just yet. Right now, things generally look good. Like we have a bank balance that, is black most of the time. I know why this is red, and we'll talk about it in a moment, and make you aware of something that's important that I've already stated, which is most government funders don't pay you up front. They require you, congratulations, you got an award to, provide a new service. And so you go out and hire somebody. You haven't received any money typically to hire that person. You're supposed to pay them, as I told you, twice a month. So you start paying them. And a lot of governments, most governments, my experience, won't. You'll then have to invoice them. Most of them are cost reimbursed. So you go through 30 days, get your costs together, you invoice, and then it takes a government agency, whether it's a county or a state or the federal government, another 30 to 60 days to pay you. And so you've got this long lag between when you incurred a cost for a new program and when you receive the money, for that cost you've incurred. And it's a big roadblock. It's a huge roadblock for nonprofits. And, as we were awarded this contract, the TPA contract, a while ago to manage the deployment of the funds to all of you and through the RFP process, that the county wants more small nonprofits and wants you to do the good work that you're doing, and yet they don't sort of fundamentally understand that the way they pay people makes that impossible. And so we've fortunately been able to, convince them of this way to pay you up front and, pay you as quickly as possible to, to manage that. But I'm only saying that to sort of acknowledge that if you've seen that in your work and it's frustrating, um, but also it's real, right? And when you take on a new program, you need to understand there's going to be a negative cash impact at the front end. And it's just as simple as you're hiring somebody, you're paying them, and it takes, the funder, typically a government agency, a longer time to pay you back. And so that's the cash flow problem we're talking about. So this is the monthly cash flow. So you see that very clearly, and I've said cash flow can be any period of time. Monthly is a standard way to evaluate your cash position, and it has to do with the bank reconciliation. And it's called close the books. Close the books is actually getting the bank reconciliation and the information in the system for what your spend was. And for us, it would be November. We got our bank statement for November. We put the information in our accounting system, and so now we're able to evaluate what our cash position actually is in November against what our budget was. And so it's for that reason, essentially our bank statements come in monthly, that the normal time period to look at your cash flow is in fact monthly, just like this. However, that doesn't work in the real world, where we have two payrolls during the month. And so am I able to, make my payroll during the month? And I don't see that in this monthly picture. And so it's super important that all of you are looking at your cash position and in a forward-looking way. And you should be looking out 90 days, because that's the cycle for us to pay you, since we pay you quarterly, on a daily basis, like I have here. Jan 1, I know it's small, Jan 1, and we see here, and all of this is not yellow, right? So all of this is coming from the yellow tabs. The only thing that gets entered here is the payments. So that's the one thing that you need to enter in here, not the costs. The costs all come, from the information because the payment is the thing that is not under, when you get paid, is the thing that's not under your control. Well, payroll technically isn't under your control because you have to pay on the dates that you've communicated to your employees. But some of your other costs, and I'm going to make this a little bit bigger, help everybody out. Payroll has to be funded on certain dates, and I have two here. My assumption is the pay cycle is the 7th and the 22nd of every month, which that's what Amity's is. It can be different for your organization. For some reason I see the 7th and 22nd a lot. Couldn't tell you why, I've been doing this for a long time. The more typical one is, end of month and mid month. So on the 15th and then the last day of the month, whether that's the 30th or the 31st. The reason I have the cash going out on Jan 4th is our payroll providers require us to send them the money ahead of time. And it may be the 5th, it may be the day before, but it's out of our bank account, which is what we want to reflect here, a few days before your pay period. So wanted to highlight that, and the other things I wanted to highlight are non-payroll costs that have to be made the first of the month. And rent is a well understood one, whether it's a rent or a mortgage, has to be paid on the first of the month. Health benefits typically have to be paid on the first of the month. And obviously we don't want our coverage through Kaiser or whoever our insurance coverage is through to terminate. And they'll be pretty aggressive about terminating it, unfortunately. And so they won't give you they may not terminate you on the Jan 2nd, but they won't give you a lot of time. And so we have to make sure we pay these the first of the month. The rest of them I have here. And you can decide when you cut your checks, or your fiscal sponsor can decide when they cut the checks. This can move, and this is an area where we have flexibility. We don't absolutely have to pay our phone bill on the 15th. We can wait to pay it if, in fact, we need to. And in my example, we need to. I was supposed to have made this. Hang on one second. We go red here, and we can't, right? We can't go red here, and so in fact, in my example here, we just wouldn't pay this. We were unable to, and so I would, if I was doing this cash flow for you, I would, push this out to, to this date or to a future date. So this is information that again comes from the income statement tab, which is this one, but the source is all in here. Like what we went through, we entered in here. That's the source. Now, what you'll need to do is perhaps move these things around. So I've now moved to cohort 1 and 2. If you didn't notice what I did, this was January's. This is cohort 3 and PA 8, and then this is cohorts 1 and 2. You'll need to move your payroll date to line with what your payroll date in fact is. You'll need to move when you have your check run. It comes, you can see where it comes from in the model, and you don't want to change that, but you can change the date in which you plan to pay your vendors, and so on and so forth. And then what ends up happening is down here, we show our daily cash as we pay our rent and pay our health benefits, and as we pay we fund our payroll, et cetera, et cetera. Our cash balance goes down and down and down. And down here, I showed the calendars for the rest of the fiscal year for cohorts 1 and 2. So the dates I showed you was just the current quarter we're in. For both cohorts 3 and PA 8, you've got the calendar down here for the rest of the year. And so what we see happening, and I am going to just shrink some things here for you. So this feature where you can hide a bunch of columns. So I want you to be able to see everything. So these dates, remember the green color? The green was the first invoice. So for those of you that got your information in, we were able to include an invoice last Wednesday, and you should expect payment in this time frame. And we would enter that in here. And in my example, I think it was, what was it, 107,000. And so now I've got a big check. I have lots of money. I easily pay my vendors. I easily make my payroll. And everything is hunky dory because I got my information on time. Now, if I miss that, I pay my vendors here on January 15th. I got into the second pay cycle, which is coming up by Friday. Then this, if you met the December 20th requirement to get all of your information in correctly for cohorts 1 and 2, we'll be able to pay you in this time frame. Now, the problem is we don't know exactly when we're going to get paid from JCA. We are on them all the time. They're great partners. We are working, on your behalf to get the money as fast as we can to turn around and pay you. But this is where, with the assumptions I put in, right, the head count and whatnot, this is where sorry, you probably saw that. That was a note from Mina. So, Mina, maybe we can address what you're communicating to me later in this call. And so, um, and so, what we start to see here is a potential problem where I may be at risk of being able to fund my payroll because I got my information in, one cycle late. And this may not be true for you, right, for cohorts 1 and 2, but in the example I put together, this is where it will flag. And if you've done this in December, you'll see this, right? You'll see this ahead of time and work to address it. Either it's focus more quickly to get your information in. One thing that's possible is you don't pay these vendors, right? These are the utilities, the communications. Doesn't help us completely, but it helps us a little bit. There's other things we'll need to do to address our, having to pay this here in January. And so that's the point of these tabs, is to take the information that's been totaled here and reflect when the cash actually goes out for those different items. And the timing's different, as I've shown here. There's really 3 different things. There's things that are due the first day of the month. There's payroll, as I've mentioned, there's 2 of them. And then there's your other vendors where you have more flexibility. And so you want to put the information in the correct day, right, of the month, so that you can then see what your future looks like from a cash flow perspective. And so what you're seeing here, I'll just sort of now shift to why this is red here. The reason this is red has to do with something I've been emphasizing, which is most funders don't pay you up front like we have. And so we started that second program, if you recall, on January 1. Well, I had to pay those people. And so if I go back to my program 1 and I just decide I don't have that program, I can't afford to pay it. What now happens is I don't have a cash flow problem. I mean, my cash is pretty tight, but it's not red. And this is an important thing for you to understand as you're growing as a nonprofit, as a business. As you take on new contracts and new programs, they end up having a cash flow burden on you. It's just true. I've been doing this for so long, and it's as simple as that concept. I know I've said it a number of times, but I need to hammer it home. It's the fact that you pay your people first, and it takes 60 to 90 days for you to get the money that went out to pay those people. And where's that money supposed to come from? Like it just doesn't exist, out of thin air. And so that's something I wanted to, make sure I highlighted to you today, is just understanding that as you take on new contracts and as you grow as a business. So, all right. I am at a point where if there are any questions.
Oh, there's a lot.
Okay, let's just start knocking them out.
Of course. All right. So, one, just to clarify, because I thought I didn't hear something, but no, everyone, this is not due during your quarterly milestone reporting. This cash flow sheet is for you to utilize for your organization, for your budgeting, for just all of your cash flow needs. So this will actually not be due during quarterly milestone reporting. Only your budget expenditure that finance uploads onto Apricot will be due during your quarterly milestone reporting. So I wanted to get that out of the way. Also, Lorenzo did put in the chat that you are not able to purchase vehicles with JCOD CFCI funds. So I do just want to point that out because Lorenzo did put that in caps. And I know caps usually means someone is yelling, so I'm sure he's yelling that out from Arizona. So let's go to the questions. Can the proportion of indirect be based on ratio of participants per grant, or does it need to be actual time spent?
Such a good question. And almost all of the time, the way your funder will require that you spread is the language I use with Sandy and team. Those costs is through a proportion of your direct expense. And so if I have $20 of JCOD direct expense, and my total direct expense, and direct expense, to remind everybody, are the costs that are directly associated with a contract or a program, not shared. It's specific to the program. And so if 20%, so $20 of my total 100 company dollars of direct services is JCOD, I need to allocate 20%. So it's a fraction of your relative direct or proportional direct expense is the most common and the most standard. Now, I will admit I've seen a few exceptions to that where a contract will allow you some flexibility and you can use something like headcount or a different driver. You shouldn't expect that though. It's super rare, and you should allocate your administrative, your program management, indirect, all the same thing, shared costs. You should allocate proportionally based on relative direct expense. Sandy, did I get that right?
Yes, basically, yes. There's a lot more complicated process, but we simplify.
Yep. Thanks. All right, Mina, what's next?
Awesome. How would I go about a staff member promotion and salary increase?
So there's a question around, best practices of the business. There's usually a change of status form that gets completed every time you have a promotion or any change in a status of an individual. You'll want to document that. You'll want the right sorts of approvals that you determine that you need or your contract may require for those increases. And so you'll want that for internal purposes, sort of a best practices. In terms of, I'm guessing the question is about JCOD and the budget. And if you want to give a promotion to somebody who's funded by your JCOD contract, how do you go about doing that? And I'm going to need help from my team answering that question.
Okay, may I?
Please.
All right, so everyone turned in a budget before you were approved, and this budget was to be filled out with your salaries, your positions. It included the hourly rate, the number of hours per week, the number of weeks per year. So if somebody comes to us and says, hey, I would like to raise a salary, okay, we're going to look at that. We're going to look at how it started, what was allocated to that salary before in terms of hours. If there's an opportunity to add hours for more work, then we would certainly consider that. And then if it's an increase change, then we would ask you to, talk about the maybe what the job change is, you know, how it relates to the scope of to the scope of work, to your deliverables in your application, right? And then we would, when you were approved for when your budgets were approved, they were approved not only measured against everyone in the cohort, but they were also approved measured against similar organizations in the same program area. So everything was taken into consideration to ensure equity across the board. And so then we would still look at that. We would still look at, you know, the salary in conjunction with the job description, the job title, and we have a resource that allows us to determine, you know, the average pay ranges and things like that. So that's how we would talk about that and determine something like that. And then it goes without saying that if you raise and change your budget, then there are going to have to be other changes made to accommodate that change. That's what I have to say.
Yeah, so great answer. I raised my hand, Lorenzo, because you addressed the last point, which is we need to make it work within your budget. And as I emphasized, you should have some surplus, and so it should be, you know, financially possible to find the money if in fact you didn't include a raise in your original budget. So nice caveat. I think, you know, maybe to summarize what Lorenzo is saying is we're just going to understand and get comfortable with the raise. So again, what changed in the job description? How much is the raise? And we have some benchmark data on, and we're just responsible for making sure, financial sort of oversight or due diligence, and that it's appropriate, right? It's not just too much, and so we'll do a little bit of a review to make sure that we're comfortable and improve it. But yeah, just submit a request and provide us the information supporting why you'd like the increase and how you're going to fund it within your budget.
Can you lease a car using CFCI funds?
Yes.
Can you share any resources that further explain indirect rates and how to maximize its utility?
Maximize its utility, did you say?
Yeah.
We will follow up on this with some links to information that comes from different government websites. The best one is the federal government. They have guidelines called the Super Circular, and it'll give you information around indirect rates. And I think we're also, from this training, we're keeping a list of future topics and future trainings. And so I'm hearing loud and clear that we should talk more about indirect rates and, you know, what goes in there, what's allowable, what's not allowable. So we'll do those two things. We'll follow up with you with links to government websites, and then we'll definitely talk about this in future training. Don.
Yes, thank you. I just want to just tag on to what you had said, reinforcing something Lorenzo had mentioned. Yes, technically, short answer is yes, you can lease a car, but again, it needs to be in service of the scope of work and the deliverables of your organization. It's not as hard and fast as a car, right? Just want to, again, put that out there.
Monthly rent budget is $4,500 and my utilities amount is $800. If I get a location at $4,000 with utilities included, how or where can I utilize the $1,300? Also, can the amount be used to pay consultant fee or just used to provide more services for my clients?
I'm going to look to my team. I just think you'll do a better job of answering. You can redeploy those dollars, those savings for sure. And so, team, is there anything you would add?
Well, what was the question again, Mina?
I'm looking at it, trying to find, there was a lot of.
The question was, I haven't spent as much in salaries or rent, and so I've got some savings. Can I redeploy those savings, to other purposes? And the answer is yes. And yes, services, yes, administrative or program management or indirect, will want to understand, you know, the reason, right, for, the new spend, the new resources. So just ask you to help us understand that. Yes, Lorenzo.
So I always tell people that you have you have funders, right? That you're responsible to answer for. And in some cases, you may give out an end of the year report indicating what your finances are. Some more robust nonprofits do that. I would say that you should be comfortable with the financial story you're telling, and that any reasonable person would find, any changes in your budget or any justifications for your spending, they would find that reasonable based on the scope of work and what you said you were going to deliver. That's it. And it's a conversation between us to understand the changes that you need to make.
And I would add to that also, this is where your grant advocates are a critical part of the proposition as well, right? Like they're intimately familiar with your program, and where we have working knowledge, they're a part of where we manage that financial end, right? Helping to paint that picture to, I think, as Lorenzo said it perfectly, tell the story. That storytelling, how is this more ROI positive in service of the community, right? As it relates to your program area. So thinking about it from that business case standpoint should help to kind of fill in the blanks, so that when we receive it through like a budget transfer form, it's clear in terms of, okay, they're moving money from here to there, and this is the upside that they're looking to generate.
Thank you, Don. Nina, what else?
If I get a line of credit, how or where would I report that on my spreadsheet?
Excellent, and great idea to go get a line of credit, for all of you. And so I am going to share my screen again. And we're going to go here. Super advanced question, by the way. This is when we get into the balance sheet, and it's reflected in one of these lines here. I didn't put a line of credit line in. I could put it in right here with other. And so as you used it, you would enter it here. Let's say you used $1,000 of your line of credit, you would enter it there. So it goes on the balance sheet. It's where it gets a little bit tricky. It doesn't sit on the program budgets in yellow. It's called capitalized, which is what the balance sheet is, and this is where I think for future training we'll focus on the balance sheet and how that works. But that's where it would go. For everybody on the call, I encourage you to go to your bank and or build a relationship with a bank to request a loan, which is called a line of credit, and it's usually secured by this line, the accounts receivable. And what I mean by that is the bank will essentially say in a loan to you, I have the right to collect these receivables if you don't pay my loan back. And that's how they get comfortable. It's called collateral. It's just like a home mortgage where the bank, gets rights to your home if you don't pay your mortgage. So it doesn't happen that they take your receivables, but that's how a bank gets comfortable. And they'll be willing to loan you up to, I've seen 60 to 70% of your AR balance. So with my numbers here, and this has to do with JCOT actually, since we think about cohort 1 and 2. Here we are in December. You're earning your December money, and it, the next quarter, and it just is going to take us till January to pay you. You have a receivable, and you can go to the bank and say, hey, I've done the work, I'm going to get paid. I need a loan to help with my payroll. can you give me a loan? And they'll say yes. If they say yes, they'll say, we'll let you take a draw, it's called, take a loan for up to, again, I've seen 60 or 70% of whatever your accounts receivable balance is. And the thinking is, you've earned the money, you're going to get it. So the banks, and they make money, they make their interest, and they'll charge you a fee to, to close the loan. And so, you should all be, expanding on the question on the line of credit, looking to a bank or trying to build a relationship with a bank, to put in place a line of credit. And that's one of the ways you can, manage a cash flow problem, is draw on a line of credit. And that can be a line here that you add in. Draw on line of credit, and it helps fund your payroll. Good question.
Along those lines, do you know of any banks that you recommend to apply for a line of credit?
I know many, and one I'm going to highlight for all of you because they like the work that we do, which is similar to the work that you do. They're comfortable lending to nonprofits. It's called East West Bank. I had, in the chat, I had put my email address in, dcrawford@amityfdn.org. You can send me an email asking for an introduction to a bank, and I will work on responding with an introduction to a bank.
If raises were accounted for in the original budget, do we have to notify Amity of the raises?
Team?
If they were accounted for in your budget, then they should be already listed for years 2 and 3. And there were a handful of budgets that did have a very modest increase in salaries year over year, but very, very modest.
In addition to the forecasting and monthly reconciliation, what other best practices are there to ensure we will be good for the audit? Do you have any type of checklist?
That's
Yeah, we can put one together for you. So let that be homework for us. And again, maybe Mina will add it to the future training. The most important thing is the bank reconciliation. Now, something very similar is if you have credit card, company credit card, there's something very similar called a credit card reconciliation. And so it is by far the most important thing that you do. But there's certainly other things around best practices, and you want to do it quickly, this bank reconciliation. One of the things I've seen organization trouble they run into is they don't do it, and they don't do it for a number of months and a period of time, and you then are, I use this term, flying blind, because you don't have your actual information, or at least all of it, in your system, and know that you do. And this bank reconciliation is the way that you can have confidence, and we'll look to that, and we'll look to your payroll, which is your biggest, for most of you, your biggest bucket of spend. So you'll want to have detailed support for the payroll that you're paying your your student, I'm sorry, your employees. Amity calls our employees faculty, excuse me, they're our client students, if you don't know that already. So very important that you, the amount you pay in your accounting system and in your bank statement, your employees, agrees to the detail. You have a signed offer letter that has a compensation amount. If an employee's hourly, you have a signed offer letter for the compensation, and you're tracking the hours. And so I'm highlighting for you two big areas that you definitely need to focus on, and it's your bank reconciliation, and think of it as your payroll reconciliation, which means the payroll that you fund agrees with the monies we're seeing in your bank statement as going out for payroll. So that needs that math needs to work. We need to and we need to be able to tie it to source documents, which is typically an offer letter, right? A signed offer letter. So those are two things. We'll work on a bigger list for you. Give us, it's the holidays, so maybe give us into early 2025, but we'll work to pull that together and likely add it to future training, that discussion.
Although California law to pay employees twice monthly, is this a compliance requirement by Amity Foundation for grantees?
Yeah, because I'm pretty sure the contract says you need to follow California law.
And that was it.
Amazing. We have 3 spare minutes. So so in the chat, I put my email, dcrawford@Amity Foundation. I'll do my best to introduce you to banks in Los Angeles County to the extent you're interested in that. And then I also in the chat said you can reach out to me if from this training you've maybe realized you need more finance or accounting resources. And think of them as contractors or consultants. And I know a bunch of people, and so so you'd have to pay for them. You'd have to work them within your budget. But if in this training you're thinking that you may need that, feel free to send me an email and I can help you with that as well. So, and then lastly, we know this is super complex. We understand the audience is very broad in terms of maybe their comfortness around Excel and numbers and so at a minimum, want you to understand the importance of making sure that you make payroll. And the only way you can do it is by using the tools and the processes that we've outlined here for you. And so if you're feeling unsure, highly recommend that you think about finding a resource to help you with this. But you definitely want to be doing this kinds of work from a finance and accounting perspective. So with that, maybe team, is there anything you would add, or Mina, before we sign off?
Yes, I actually do have one final thing for all of our grantees on again. So I don't know if you guys have seen the bulletin or heard from your grant advocate, but we are changing up how we send out TA technical assistance emails. So if you want more than just the contract signer and maybe a data individual to receive the emails, the invitations to webinars, please fill out the form that I just put in the chat. Your grant advocate will also be sending this out, but starting in January, we will be having a new contact list for all emails. So please fill out that form and it will ensure that you are on that email list. Thank you. Also, all of the materials and the recordings are on our website, Amity and You. I will put that in the chat as well. And if you ever have any questions, please feel free to reach out to your grant advocate. They should always be your first person to contact. They would be able to get you in touch with either myself, with data, or with your finance rep. Again, each cohort year has a finance representative. Year 1 has Lorenzo. Year 2 has Dawn. And year 3 has Samuel. And David and Sandy are just extra sprinkles on the cupcakes here. Always contact your finance reps before you push it up the chain of command. All right. Anything else from the finance team?
Just thank you, Mina. Appreciate all the
Thank
support. And thank
you.
you, team. Really appreciate the help putting everything together. And thank you all for attending. And good luck with cash flow.
you, everyone. Have a